All right, let's get straight to it. The market is caught in a massive tug of war between some powerful bullish forces and very real downside risks. We're going to break down the key levels, the catalysts, and the risk-defined strategies to navigate what's coming.
So, which is it going to be? A classic year-end rally or a Q4 collapse? Right now, the data is pointing in both directions at once, which really just guarantees one thing. Extreme volatility is on the menu. The real question isn't just about direction, it's about magnitude. Are we looking at a 10% rally or a 15% correction? Let's lay out the battlefield. In the bull corner, you've got strong Q4 seasonality, a Fed that's suddenly sounding dovish, and big institutions buying every single dip. But in the bear corner, you have geopolitical threats, a potential government shutdown, and investors positioned for maximum risk. Yeah, this is the kind of setup that precedes a major, decisive move. Now, check out this number, 3.8%. As of October, that's the cash allocation for fund managers, a 12-year low. You know what that means? It means everybody is already all in. There's no cash on the sidelines to sop up any selling. So if a real sell-off starts, there are no buyers left. That's exactly how a gamma flip can get triggered and amplify a move to the downside, fast.
But here's the wild part. Even with that extreme risk exposure, you've got major firms like Evercore ISI pounding the table for a huge year-end rally, calling for 7,400 on the S&P 500. You see the tension, right? Maximum risk meets maximum bullishness. One of these sides is going to be spectacularly wrong, and that means the resulting move is going to be violent.
So this isn't some far-off problem. We're in a critical risk window for the next 2 to 3 weeks. And the 50-day moving average, that's the line in the sand. Let me be clear. A decisive close below that level on high volume is not the dip you buy. It's a technical signal that could trigger a very rapid 5 to 7% correction as a cascade of stop losses get hit.
And look, this isn't just some abstract theory. We have a clear calendar of catalysts that are going to force this market to make a decision. This week, we've got earnings from market movers like Tesla and Netflix. Then, Friday at 8:30 a.m. Eastern, we get that rescheduled CPI report, which could totally change the Fed narrative. Then next week, it's the US-China trade meeting and the November 1st tariff deadline. Any one of these could be the spark.
If you want to understand where the whole market's headed, you have to watch the leaders. And right now, that's the semiconductors. This entire sector is sitting at a make-or-break technical level. If names like NVIDIA and Micron can't hold their trend lines right here, that is a major, major warning signal for the entire bull case.
And hey, don't just take it from me. Institutional analysts are calling semiconductors the bedrock of this bull market. And they're right. If that foundation cracks, the entire structure is at risk of coming down.
Okay, before we dive into specific scenarios, here's the mandatory disclaimer. This content is for educational purposes only. It's aggregated analysis from public sources designed to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
All right, let's talk actionable levels. The base case is for choppy price action, probably between S&P 6550 and 6700, as long as we stay in positive gamma where dealers are buying dips and selling rips. The bull scenario triggers on a decisive break above 6700, especially if you see the VIX hold below 1850. But the bear scenario? That's the one to watch like a hawk. A break below 6550 risks that gamma flip, where dealers are forced to sell into weakness, accelerating the whole move down. That is the #1 risk right now.
Okay, so let's start with the bull thesis. What could actually drive this market up to new highs by the end of the year?
Well, the bull case rests on 4 key pillars. First, you've got seasonality. It's a massive tailwind. November and December historically average a 5% gain. Second, the Fed is clearly pivoted dovish, which takes a huge headwind off the table. Third, we are seeing massive institutional dip buying, over $20 billion in inflows on the last major pullback alone. And finally, any kind of positive news from the US-China trade talks could remove the single biggest source of uncertainty and just fuel a rally to new all-time highs.
Now, for the other side of the coin, the bear thesis. What could actually trigger that sharp correction we've been talking about?
The bear case really hinges on 4 potential triggers. Number 1 is a technical break of S&P 6550, which, as we said, could trigger a gamma flip and forced selling. 2, a prolonged government shutdown would create real economic drag and a ton of uncertainty. 3, a hot CPI print on Friday would completely derail the dovish Fed narrative. And finally, with everyone already all in, any rush for the exits will be crowded and it will be severe.
So, how do we translate all this analysis into actual risk-defined trades?
Let's walk through a few option structures that line up with these themes.
First, a bearish idea on Oracle. The thesis is pretty simple. The stock looks overvalued after a strong run, and there's been some insider selling. A bear call spread is a high probability way to play this. You're selling premium, betting that the stock will trade sideways or down. It's a defined risk structure. Your invalidation point is a strong break and hold above its recent highs. This is a starter size position.
Next up, a direct hedge against our primary risk scenario. If you're concerned about that S&P 60/50 level breaking, a put butterfly on SPY is a low-cost, high-leverage way to target a sharp move lower. You can set it up to have a max payout at a specific price target, say 635. Think of this as a pure portfolio hedge specifically for this 2 to 3 week risk window we're in.
And finally, a bullish idea. Because if the market does hold up, you want to be in the leaders. Micron, in that critical semiconductor sector, is a high-momentum name to watch. The thesis is to buy a pullback right to its 50-day moving average. That's a key level of support. You can do it with stock, or you could sell a bull put spread to get paid while you wait. The invalidation is crystal clear. A failure to hold that key moving average means the thesis is wrong.
And let's close with the final disclaimer. This is not trading advice. It's a market update to keep you informed. All markets carry risk. You need to trade your own plan, manage your downside, and always verify all the data yourself. So that brings us to the final question you need to be asking yourself. In a market stretched this tight, is all this coming volatility a risk to be feared, or is it the exact opportunity you need to generate alpha? The answer to that question is going to determine your P&L for the rest of this year.